Okay, good morning and welcome to MACROACE with your host Tony. Going through non-farm payrolls and also the Canadian employment change data. Got quite a bit to kind of go through in regards to sentiment and what to expect. So thank you for joining me slightly earlier in the morning than you might usually would for a live stream. But don't forget to share this video and also to let your friends know about it as well. Don't forget to like and subscribe to the channel. So non-farm payrolls then. What is it? So non-farm payrolls measures the net amount of jobs created in the prior month. And we have two different surveys. We have the household survey, which is where the unemployment rate data is compiled from. Okay, asking people in either an email survey or over the phone, whether they're employed or not, part-time, full-time. And then we have the establishment survey, which is the more trusted survey, and that's where the non-farm payrolls figure comes from itself. Basically asking businesses in over 440,000 different business sites or work sites around the USA about how many people that they have, or how many jobs that they've created, or how many people that they have on their that they've employed altogether. So that together then combines, of course, household survey and the establishment survey, the non-farm payrolls report. Now, how does it affect the markets? So first of all, we have the currency, which if you do have a strong non-farm payrolls figure, it shows the economy is doing quite well and job gains robust and people are likely to spend more money, which puts confidence into the US economy and the currency itself. And you see a strengthening from, the US dollar. Also, another reason why it also sees strengthening as well is because of how if non-farm payrolls is much stronger than expected, then what can happen is that the Federal Reserve might decide to go with a stronger rate hike, or may decide to tighten for longer than than markets may initially have anticipated. So there's also that risk there for the currency, or another reason why the currency could move towards the upside. Now, for the stock market, usually a strong non-farm payrolls figure when there's no tightening from the central bank, no inflationary pressure worries, we see more normal market conditions or economic conditions, then usually the stock market sees a rally too. But in this current scenario, or this current market conditions that we are in at the moment, everyone's focused on inflation, bringing that down in the USA. And also one of the mandates is one of the things is that you don't want job gains to overheat, because then that will lead to in the future inflation picking up again. So it'll be a constant vicious cycle. So if you do see really strong non-farm payrolls figures today, that could lead to the stock market actually seeing a movement towards the downside or depreciation if that happens. Now, for the bond market, very simple. If you see that there have been less jobs that have been added, then the bond yields will see a movement towards the downside. The reason being is that the traders may be thinking that the central bank in this current scenario probably go for a smaller rate hike rather than a bigger rate hike at an upcoming meeting, or maybe start to ease off the gas pedal and maybe bring their rates to where they want to much sooner rather than later, or they don't have to go that high. So there's also that factors in for the bond market as well. So also, of course, with the bond yields and the bond prices, if bond yields go down, bond prices go higher. That's something also to note as well. And we'll go through the deviations of the economic release of what we've seen in the past to just kind of back up what I'm saying, basically. So the indicators weighing on sentiment then at the moment. So we have inflation, which is at 7.7%, lower than the prior of 8.2%. The PC price index, what we had data that we had yesterday at 6% versus the prior of 6.3%. Core PC price index also lower as well, 5% versus 5.1%. the GDP Q3 second estimate at 2.9% versus minus 0.6% for the second quarter. Also, the unemployment rate in the US is still sitting, well, it's kind of been jumping backwards, back and forth between 3.7% to 3.5%. There's also been that's been quite a tumultuous, actually very choppy bit of data that we've had recently so far. The markets have reacted in a very choppy way themselves as well. With when we had one of the unemployment, when we had Nonfarm Payrolls data back about for the last one that we had, I think it was a couple of months ago now, where the Nonfarm Payrolls data had seen minimal deviation on the headline figure itself, but the unemployment rate jumped by 0.2%, and that led to a bigger market reaction. So also to other look at as well, and we'll go through the deviations for that later on. So ISM Manufacturing Employment Index was at 48.4 versus 50. JOLTS, so we had data this week as well, representing September. Remember, not October. It was at 10.334 million versus 10.717 million. And then the employment cost data at 1.2% versus 1.3%. And then finally, this week we had ADP employment change. So it came in at 127k versus the prior of 239k. And we also had a very good market reaction from the ADP employment data. Now, people and traders, sometimes what they do is they consider the ADP to be a precursor to kind of what to expect for the non-farm payrolls or the headline figure on the Friday. On the Friday. So if, let's say for instance, if the ADP data does come in smaller than expected, then that could lead to traders possibly thinking that the non-farm payrolls could see a decline instead. So the market reaction that we've seen from ADP this week was they had seen the dollar see weakening off of the worse than expected data, and the S&P 500 actually saw strengthening from that data. The reason being is that if there are less jobs being added to the economy is not able to be as robust as expected, then that leads to the expectation for the Fed to maybe go with a smaller rate hiking path. But ADP isn't always, there isn't always a very clear connection between ADP and non-farm payrolls. ADP has a different way of measuring things. They focus on private employment data, and they collect that data and make their own estimate, whereas non-farm payrolls is from the government and focuses on every area. So manufacturing, private payrolls, government payrolls as well. That's also taken into account with the non-farm payrolls figure. That's why the non-farm payrolls gets a bigger amount of views, let's say, compared to ADP, which is, again, still important. Can't really put it away because it still has a market reaction. But non-farm payrolls usually has the stronger reaction in the markets. Hello to Django. Django, hello. So it says, hello, sir. Hello to you, sir, too. Thank you very much for joining. Don't forget, share this video with your fellow friends and traders. Now, triggers then for the economic release, the juicy bit of the day. So non-farm payrolls, so we're looking at a high estimate according to economists, what they're looking at 270k. So that'll be a 70k deviation, according to what they see. And then they have a low estimate of 60k. So that's a deviation of 140k. So I think in general, what we've seen with the non-farm payrolls data, you can say, I mean, if we go to, actually, let me just bring this up here. Where is it? Where are you? Non-farm payrolls. Here we go. Right. Here we are. Here are the deviations. So let me explain what deviations are, right? So deviations just shows you how strongly the markets react to an economic release and the figures that have been presented. Okay. So this example here, right? there wasn't too much of a deviation in the non-farm payrolls data, but the deviation, well, the bit that moved the market was the unemployment rate ticking up higher. So that's why you'd seen the S&P and the NQ seeing a movement towards the downside there, and also the rest of the report wasn't that bad. It wasn't that bad. It was more or less in line with the expectation. So it wasn't a blow up figure either. There's also that point to make count as well. But if we were looking at the data for this time round, or the last time round that we had data for non-farm payrolls, there's about 60k deviation at least that had caused, and a more of a positive report for non-farm that had caused, although it wasn't as strong as the last one, it still had a strong, decent reaction on in the stock market. Currency pairs, you can see here, there was that initial move on the dollar, seeing some strengthening there, but after about 10 minutes of trading, that's what the brackets represent. More or less, it decided to go flat. The only thing that did have a good move was dollar CAD. So that could be something to look out for, the dollar CAD, with today. But historically, if we're looking at the main currency pairs that have had a decent reaction to the release, you're looking at, of course, cable, the euro dollar, and the dollar yen. Those, of course, are widely traded, and there's a lot of liquidity behind those currency pairs, right? So that's also another thing to bear in mind. But if we're looking at what reacted the strongest out of those currency pairs, historically, we're kind of looking at cable at the moment. If we're comparing it to the last 3 months of releases that we've had from cable. And then, of course, the 2-year yield, or 2-year bond price had seen the biggest movement last time around with non-farm payrolls. So I think deviations-wise, one thing you've got to be aware of is how the unemployment rate data comes in and how that might move the market. And then also you've got to take into effect that if you do get at least a 60k deviation, actually, to be honest, I think on the high end we'd look for 100k deviation maybe, but 60 to 100k deviation on the non-farm payrolls figure, a headline figure itself. But then you'd also want the other figures to be in the positive range, like the unemployment rate to head lower, private payrolls to see an uplift as well. Then you'd probably see a stronger reaction from the dollar. But those are the deviations there. Don't forget, this data that I'm showing you here is completely free, right? It's only free only accessible to our users or to our subscribers to the mailing list. So let me pop that into the chat for you here. All right, there we go. That's the MACROACE mailing list. Again, it's free. Shows you how economic release, or how the markets react to certain economic releases. That's what we kind of focused on. What are the big movers? Like last time, we didn't do PPI, because in the past they hadn't had that much of a reaction. But then the last report, it decided to explode. So that's going to be when that does come up again, we're definitely going to be doing the PPI data. If we're looking across, but yeah, so some of the releases we may have. The key thing is we're malleable to what releases we kind of select and do a live stream on. Some releases, they usually would have had a decent reaction in the past, or good reaction in the past, a good amount of movement, and now they don't. So that's something also to be aware of too. It's more or less just kind of focusing on what's really going to move the markets, just to kind of help you guys focus on what you should be or could be looking out for in your trading day. Now, back to the triggers then. So the US unemployment rate, economists see a high estimate of 3.8% with a low of 3.6%. Average hourly earnings of 4.7 with a low of 4.6%. That's also going to be quite key too, the average hourly earnings data. Private payrolls, high estimate of 249k with a low of 120k. Then if we look at the investment bank views as well. So JP Morgan see non-farm coming in at 260k with the unemployment rate to come in at 3.6 to see a slight decline there. Then if we're looking at Deutsche Bank, so they see 200k with the unemployment rate remaining unchanged. Credit Suisse, 225k, also expect the unemployment rate to remain unchanged. And then Morgan Stanley with non-farm payrolls expectations to come in at 180k, expecting the unemployment rate to tick up to 3.8%, so 0.1 deviation on that there. Then if we're looking at the previous report, leisure and hospitality added 83,000 jobs in September, in line with the average monthly job gain over the first 8 months of the year. Within the industry, employment in food, services and drinking places rose by 60,000 in September, and employment in leisure and hospitality was below its pre-pandemic February 2020 level by 1.1 million or 6.7%. And in September, employment in healthcare rose by 60,000, a return to its February 2020 level. Over the month, ambulatory healthcare services and hospitals each added 28,000 jobs. So that's what that shows that the economy is still strong. Not really showing that much employment in the goods, services, goods area of the economy, but services are picking up again. So that's quite key. Are people move from goods to services, right? And if there's a need, if the people have a demand, the consumers have a demand for more services, then you're going to need more people in that area. And it also means that people have more money to spend. Maybe it's because, we're leading up. First of all, you have, COVID is kind of nearly gone. There's no restrictions. People are we're also getting towards the Christmas period, and also, people want to be able to spend some of their hard-earned money that they would have had. So there may be more of that demand in the leisure and hospitality area. A non-farm payroll increased by a larger than expected 263,000 in September, despite being the smallest monthly increase since April 2021. Fed and government views. Fed's Harker said the jobs market is still hot. However, I expect the unemployment rate to rise to 4.5% next year. Fed's Barnes said the Fed will be data dependent, and one of the indicators we'll be looking at is the employment data. Waller said it makes me nervous that businesses are factoring in a lot of wage growth, which will keep inflation high. Mester says labor demand continues to outpace worker supply. And then also from the Fed minutes as well, participants observed that the labor market remained tight, and many noted tentative signs that it may be gradually moving towards a better balance of supply and demand. So more or less just an easing of the pressures that we've seen so far in the US economy. Sidesar says, do you have any analysis about personal spending and income? Yes, if you had joined, I did a stream on that yesterday. You can watch the video that should be on the YouTube channel to be able to look at that. It would be old, of course, but if you want to look at it as a historical reference, then by all means, do have a look at it. Investment bank views. So JP Morgan economists, the US could shed over 1 million jobs in a recession. Citi envisions a pound push scenario in which the Fed is compelled to hike even if the economy slows, and BlackRock sees no chance of a soft landing in the US or Europe. Bank of America said its private clients are flocking to bonds and away from stocks as they anticipate a recession. Bond funds attracted inflows for the 39th week in a row, quantity strategists led by Michael Hartnett in a note. bonds are preferred by analysts in the first half of 2023, with stocks becoming more appealing in the final 6 months of the year. Just as what they said then, to quote, they remain bearish on risk assets in the first half, with the narrative shifting from inflation and rate shocks in 2022 to recession and credit shocks in the first half of 2023. So I think one of the things that we've seen from the market reaction recently this week, of course, with Fed's Powell, the big dog stepped up, and he, more or less reiterated what the markets were expecting or are expecting the Federal Reserve to do at the December meeting, which is, saying that they will slow the pace, see it as appropriate to slow the pace of rate hikes or the rate increase pace. Just saying that, not directly or, not explicitly saying that, yeah, the Fed's going to go for 50, but the markets knew what he meant by that, and they priced in priced in a 50 base point rate hike even further. So then you'd seen the stock market rally and the dollar decline. So, those kind of comments may shift these comments that have been made by some of the investment banks, but he kind of was mentioned in the FOMC press conference that we had last time round, that it may be appropriate to slow the rate of the pace hike rate. So it wasn't completely new. It was more of just a confirmation or reconfirmation again of what had been said, and kind of just clarifying that December, it sounds like a good time to slow down the rate of slow down the pace of the rate hiking path. Also, JP Morgan analyst on November 29th said that markets now have a clearer understanding of the Fed's direction, and they said the dollar is no longer the one way buy it has been this year. There is yet time for currencies such as the euro and the yen to rebound. And I think that's also been quite clear and evident from how we've seen the markets react as well from Fed's Powell. And also the data that we've had from the economic releases over the past week with ADP, the GDP data, and also the ISM manufacturing PMI had somewhat of a reaction, not that much, but it had a little bit of reaction too. But even that, markets are still sensitive to those releases, or to US releases overall. But yes, the dollar, of course it didn't appreciate this week. It had seen a decline this week. Apologies if I sound stuffy. I apologize for that. All right, so if we look at the video that we had from last time round, I'll just make that a big screen. So this is how the markets, so this is just a historical view of what we'd seen last time round. This is about 10 seconds before the release on November 4th. Okay, so you had the Canadian data came out, Nonfarm Payrolls was at 261k versus the forecast of 193k. You see how the markets try to react? You see that? Actually, I'll go back. Oh, whoops. Ooh, wait a second. Apologies. Let me go back. So you can see, I'll probably be able to. I'll let it play. So even before the economic release comes out, you see that the markets are trying to anticipate, that the non-farm payrolls data is going to come in, smaller than expected. But it doesn't. It comes in higher than expected, right? And then you get that. Then you get about a 60k deviation, and you get this reaction here, where the S&P 500 or the S&P 500 sees a decline. But also to note, the unemployment rate did tick up by 0.2%. So that's also one thing that could have caused the earlier little blip towards the upside there on the S&P. You can see GP CAD had a decline there as well. If we're looking at the Canadian release as well, which we'll kind of go through a bit later. The Canadians actually smashed it with their release. So they had a nicer reaction on the on the Canadian dollar compared to the US dollar and how it reacted. With if we kind of go forward, CAD, see what else we got. Let's see. Right, so that was the release there. We'll kind of go forward. Might as well go through what happened with Canada too. Catch-up Hawaii, look, that was a nice release there. Again, very nice reaction. And look, comparing it to the USD JPY, the Canadian data, because it was a much bigger deviation in the Canadian data compared to the US data. You've actually seen a bigger reaction from the Canadian dollar overall when we're looking at the market reaction. And again, the US data wasn't a complete blowout where you had a really good figure from it. Also, don't forget, share this video, subscribe to the channel as well. We've got about 20 minutes or less than 20 minutes. We get the non-farm payrolls figure and the Canadian employment change data as well. Okay, so that was the Canadian data there. Just kind of pause that. Get that out of the way. That's Canada time. Hello, Bricktop, and yes, hello, chat. Hopefully you're doing well. Good to see you again. Let's go. All right, so the Canadian data then. So we of course know what employment change is and what the unemployment rate is. How does it affect the currency and bond market and stocks? I think we've already discussed that. It's going to be the same thing for Canada as well. Stocks better than expected, much better than expected. Canadian data, employment change data, you're going to see the currency see a movement towards the upside, the bond market see a movement towards the downside. That's bond prices, because of course the yield would go up. And stocks, Canadian stocks, would see a move towards the downside if you do see a much better than expected Canadian employment change data. And then the previous report we had, employment rose by 108,000 or plus 0.6% in October, recuperating losses observed from May to September. For 4 months, there were declines or little change. So there was no real clear path of whether we're actually seeing strong momentum in the Canadian economy. But here we are. So again, instead of going from 4 months of decline or little change, which kind of made the release not so tradable or not really nice to trade, you had a clear figure that just came out and said, hey, we've added 108,000 jobs rather than minus 20k or plus 10,000k here or there. It was actually a nice clear move. So it depends whether or not this is going to last, or if we're going to get another much higher than expected Canadian employment change data. The median estimate is for 10k versus the prior 108.3k. Then the inflation rate. Where is the economy at the moment, right? So the inflation rate is at 6.9% unchanged. GDP quarter-on-quarter annualized at 2.9% for Q3, which we had data this week, versus Q2 of 3.3%. GDP month-to-month as well, unchanged at 0.1%. As said, the employment change, the prior, much higher than the prior at versus the prior of 21.1k. And the unemployment rate was also unchanged at 5.2%. And then the S&P manufacturing PMI 49.6 versus 48.8. Then the triggers then for the Canadian employment change data. And also I'll bring up the deviations too, and we'll kind of go through what our kind of deviations would look like. But you had, so according to economists, they see a high estimate of 27.4k with a low estimate of minus 25k. So look for about a 17k or about a 20k deviation, let's say, for the high end, and then for the low end, again, they're looking for a 15k deviation there. But it's quite a small deviation compared to what the median forecast is. We'll look through our deviations too. The unemployment rate at the highest, see a high estimate of 5.4% with a low of 5.2%. So what is the other sentiment and views, and what are central banks saying? So this is also another thing too that can have an effect on the Canadian economy and also the Canadian dollar. So bad news is still good news for when we're looking at for traders. They'd rather see bad economic data that will lead to smaller rate hike expectations, as I said with the US Nonfarm Payrolls data. But when is that going to turn around? When is good news actually going to be good news and bad news is actually going to be bad news? Well, that will probably come along when the Federal Reserve or the central bank pauses their rates, and they, slowly, or they might go into a mode where they start cutting the rate instead if they've over tightened. So one thing that traders would want to see is that they would want to, at that point, they might be scared that the economy, does go into a full-blown recession, that it really hits hard at home. So they want to see the economy that can manage that and can actually survive. So maybe actually better data would become good news rather than bad news instead. But we're far away from that at the moment. The oil price cap mania that we've currently been seeing with Russia and Europe and the rest of the world. Currently, delegates are in Europe are looking at $60 a barrel for Russian oil. Russia currently receives around $60 a barrel too, but that's going to cause havoc in the crude oil market as well. If you set a price cap for a certain amount, there's the expectation that the Russians could retaliate, and they've said in the past that they would retaliate if there are price caps imposed on them. And that could send WTI crude skyrocketing or flying high. But one other thing to note is that if the price cap is around what the Russians are already selling their oil at, then it might not have that much of an effect to Russia's economy, but it's more the political effect that it has on presenting Russia as this nation that could that will continue to use energy as a weapon, and that they need to kind of control them and try to, in that way, they could help Ukraine win the war. November 10th, you had Macklem said that a minor recession could be the price the bank is willing to pay to reduce inflation, and also went on to say that the labour market is very tight. So again, the key thing you've got to take away from all of these different central banks is that they will do what's necessary to bring down the big ugly dog of inflation, or what we call inflation. Okay, inflation is not a beauty. Something is up with it, and it needs to be done. And the best way the central bank can do that is by raising interest rates as much as they can without trying to hurt the economy that much. Of course, there will still be some sort of pain whenever you raise interest rates to the economy, but it's trying to avoid the inevitable of a recession, and then stopping that from becoming a hard recession or deep recession within an economy. So, investment banks' views then. So, CIBC, they see employment changed at 10K with the unemployment rate to go up to 5.3%. Scotiabank sees the employment change at minus 10K with the unemployment rate at 5.3%. BMO, same as CIBC, employment change seen with 10K jobs being added to the Canadian economy with the unemployment rate also at 5.3%. So that is the Canadian data there. I'm going to bring up the deviations again because I want to look at how the Canadian employment change data had reacted. Now, this is a much better reaction from what we've seen in the past, okay, with the Canadian data, right? Now, recently we've had a string of releases where the Canadian data has been set alongside the US data, so it's been overshadowed. The only time where it won't overshadow the US data, or actually it will overtake the US data, is if you get US data isn't that strong, right? Is actually weak. If the US data is weak or there's no real surprise or enough of a deviation from the US data, well, this is what happens here. You actually see the Canadian dollar enjoying a bit more of a reaction compared to what the US currency might do. So we'd seen there was a near 100k deviation for the employment change data itself, and this is how the markets reacted. So cable had seen a very nice reaction of 80.4 pips down. You'll see the EuroCAD also seeing a much bigger move, or nearly twice the amount of movement that it had done in the past in the previous release. New Zealand dollar, Aussie dollar had also seen a decent reaction as well. I think I was looking at Euro Swiss franc here. Martin Fit for FX says that, can you share this Excel with us? Yes, there's also the link here. Actually, let me pin it for you guys. The link to subscribe to get the deviations is here. Now, remember, I'm only presenting the deviations for the upcoming economic releases for the week ahead. So you don't get the whole thing, right? You'd only be the releases that are relevant, because, of course, some of the other releases, I'll be updating them as I go along. But it's sent out in one email every Sunday to you guys to have a look at as well. And with that email as well, so actually if I just bring it up, can I bring it up here? I can probably bring it up here. Let me see. Will this work? No. Okay. But also just to let you know as well, for the week ahead, I also provide a breakdown or a short summary of what to expect at the Asia session, Europe, and US. You said thank you, already subscribed. Oh, you should have received it. Or did you? Sorry, did you mean you just subscribed now, or have you subscribed before? Because if you've subscribed before and you still haven't received it, then we might have an issue. You might want to check your inbox for any areas. Oh, you've done it. You've done it now. Okay. All right, so that is the deviations. I think, to be honest, to look for a strong reaction here, I think we'd want to have at least a 50k deviation. I think. You know what? Actually, to be honest, I think to get a nice strong reaction from the Canadian dollar, probably look at least a 70k deviation for the employment change data. You don't want the unemployment rate to also go down as well, and the average hourly earnings to go up. So you want everything to kind of be showing a much hotter than expected employment change data. So if we're looking at the forecast, you'd want it to, if the median forecast is 10k to 180k, or around 80k, potentially to see a stronger movement for the actual figure. So again, at least a 70k deviation from my point of view, from what we've kind of seen with the last release and how the release has reacted in the past as well. So that is the deviations there. We have about 6 minutes left. Let me close out of that. Right, so don't forget, FinancialJuice is where we're going to be getting the live data for you guys in real time. Okay, I'll get my TICKSTRIKE up and running as well. Expectation for NFP. Yeah, I believe I'd just given that. So if we're looking for, economists look for at least a deviation of 70k for the high estimate. So we'll also be looking around a 70k deviation for the non-farm payrolls data itself. Apologies again, my nose is really stuffy today. So if If it sounds like I'm kind of choking, I'm not. All right, so we've got about 5 minutes left to the release. I'm just going to get my tickers up and ready. So if you're unfamiliar with what TICKSTRIKE is, so TICKSTRIKE just allows you to measure the order flow within within a certain asset. Okay, so another way to simply put it is it measures the strength of the buying or selling momentum that there is within a certain asset. Moves around here. Get this up here. Actually, let me get CAD JPY, because I know that if we were looking, if we are looking at the Canadian data with the US data at the same time, then that actually you might not get a clear reaction on the dollar CAD enough to kind of show what the Canadian data actually do. Did it strengthen? Did the Canadian dollar strengthen or weaken? So I'm going to leave CAD JPY up there, but I will have the USD CAD there, the loonie there, just kind of see what kind of movement we're seeing. Right. Whoops. There we go. CAD JPY. Right. Seems. Okay. So let's get the down there. Hit the NQ, and then we're all good. All right. I will be back in a couple of minutes. Right. We have 1 minute remaining for non-farm payrolls. 1 minute to go. So there we go. Dollar. I'm back and ready. So remember, we're looking for at least 70k deviation on the non-farm payrolls figure itself to get a really nice strong reaction that's going to sustain itself or continue to move throughout the day, and also for the Canadian employment change data too. But be wary of the unemployment rate if that does spike or does spike down. 10 seconds left to the release. Okay, 263k, high in the forecast of 200k. So the Canadian unemployment rate, Canadian employment changed at 10.1k, so slightly higher than the 10.10k. Canadian, if we look at the US average hourly earnings as well, 5.1%. Also for the Canadian unemployment rate, 5.1% as well. Lower than the forecast of 5.3%. Average earnings year on year, I said 5.1%, higher than the forecast of 4.6%. Private payrolls, 221k, 221k, higher than the forecast of 185k. Average work week hours at 34.4 versus lower than the forecast of 34.5. What else we got? US manufacturing payrolls, 14k, lower than the forecast of 18k. Yeah, so, or more or less, if we're looking at it overall then, so the Canadian unemployment rate ticked down 5.1%, 0.2% deviation there. And the Canadian data, the employment change had a 0.1k deviation. The employment change data, the CAD is moving towards the upside. But the major reason why the Canadian dollar is moving higher, one is, remember the last time around we had this data here from Nonfarm Payrolls. It's because the US dollar is doing really, really well. So if the US dollar is doing really, really well, or any dollar denominated currency is doing really well, then the other dollar denominated currencies will also do well as well. Of course, in this case, if I was to bring up the dollar CAD, you would probably, as you can kind of see just from TICKSTRIKE alone, the dollar is stronger. But overall, all dollar currencies will appreciate if you do get if you do see this, as we can currently see this scenario, if one of the dollar currencies just crushes the other, crushes an economic release, or dominates the market, or KJPY is moving towards the side. Dollar yen. So we did get, we were near that 270k deviation. Excuse me, 270k. Near that 70k deviation. And just going to double check the unemployment rates remain unchanged. So solid jobs report there, leading to the S&P 500 taking that big old tumble. I kind of just measure it now. So S&P, that's 242 ticks. Let's get the Dow. Well, we'll also look at the NQ. The NQ always has the biggest moves. If we're looking at tick wise, out of these indexes. Okay, 385 ticks. Okay. All right, here we go. 950k, 950 ticks down. All right, dollar yen. Oof, okay, that's quite nice. That's a really good move. 109 pips towards the upside. GPUSD. That's usually had a very nice move as well. I think it was also the biggest move the last time around. Double check it here. I don't think it might be. All right. No, 82.7 pips. Oh, there we go. All right. Bond prices. Bond prices go down. The bond yields go up. Ooh. That's about 80 ticks. Gold is probably good. Is going to be up as well. See how much it's up by. Oh no! What the? Hold on. How is gold down? Wait a minute. Oh, sorry. Yes, of course, it's better than expected data. So yes, the gold would be down. Yes. So I was looking at that. Okay. Well, yes, of course, better than expected data, gold would go down. Yes. 133 ticks was downside, and there's bond prices. KJPY. So remember, as said, even though there wasn't too much of a deviation on the Canadian data, it still means that the other Canadian, other denominated, dollar-denominated currencies would see an appreciation. If you see one of the currencies seeing a huge appreciation, of course, they won't strengthen against that currency that has strengthened. So, CAD is seeing movement towards the upside, but dollar CAD, of course, the dollar being the dominant dollar currency at the moment in the market. KJPY, nice. Okay, go. Dollar CAD. There we are. So 60 pips there. Nice. GP CAD. Anyways, well done to Drew, who was doing the economic release. Again, nice solid bit of reading there from our very own Drew at FinancialJuice, one of our financial analysts. So that's the second time that he's done the report, actually. So it sounds like a pro. If you are listening into the stream. All right. Yes. Okay, so that is the economic release. Thank you very much for joining me live. Bricktop says, are you doing the reads too sometimes, Tony? Yeah, well done, Drew. Well, to be honest, no, I haven't done. I haven't read the Nonfarm Payrolls release live out on the microphone in a very, very long time. Actually, I've kind of, because now there is a team and we're growing in FinancialJuice, I can't always jump in and take over. So I have to let the other analysts, grow their wings and fly and soar as high as they can into the sky. So they can take credit rather than me. And anyway, jumping in and doing Nonfarm Payrolls, it's great, but you got to let the other people take over responsibility. That's how you build a business. There is a guy that sounds similar. Thanks for the stream. Yeah, I think we've had a comment from a dude in America said we all sound the same. So hey, there you go. But like I said, so the MACROACE, so FinancialJuice, let me kind of go through it here, right? The data they had coming out live on the feed, we can see here that it's just closed. Let me just temporarily close TICKSTRIKE. So FinancialJuice live, you have the live economic release data as well. So live voice and text service. Let me just kind of explain what that is again to you if you've never come across FinancialJuice. Then a live voice and text service is basically there to help you manage your risk and capitalize on potential trades. Of course, as you see fit and how you want to use it, that's down to you. But a live voice and text service is essential to understanding why the markets are moving in a certain way. Okay, and what's causing the market reaction, or who's speaking at the moment? Is it Fed's Powell that has said something about monetary policy or future monetary policy that has caused the markets or the S&P to fly? Right, talking about rate increases or decreasing the pace of rate increases. So there's also that too, So that's something that people need to have their ears to the ground to, or keep an eye on, because that, as we've seen here, you have the economic release, and we've also had examples in the past as well with speakers move the markets, and people say, "Why is the market moving?" And then it is on the FinancialJuice website, and you have an explanation there, or you have somebody voicing it over on the microphone to you. So we have the pro version of FinancialJuice, which you can have a play with. Again, we have the live version of FinancialJuice, which of course you can use and have a play with. But what you want to do is you want to be able to listen into the stream live with no delays, no adverts on the website at all, no delays to the data or the headlines or voice. So it's better to, if you really want to capitalize on your trading or really want to boost your experience with it, of course, if it's the first time you've come across a live voice and text service, probably better to have a play with the light version, the free version, see how you kind of find it. And then once you're kind of ready to kind of move up, to the pro version, then definitely do that. So, take your time with it. The pro link is out there I've just pinned that too as well on the chat and the live chat for you. Alien Killer. What's it all with this like Alien Killer and Django Killer? What is this? This is some weird YouTube names you guys have got. But anyway, thank you for saying FinancialJuice is great. We appreciate that. Right. So that is FinancialJuice. That is the, again, the link is there in the box. Don't forget, like this video, subscribe to the channel if you found this content useful, and also, share the video with your fellow friends and traders as well, and also share the channel with them too. Bring them to us to get them to jump onto the live stream. Don't forget to give MACROACE a like or follow on Twitter as well. We do have a Twitter account. It is growing, so we are there. Get that awareness out as well. Also, unusual activity. So if you like trading unusual volume activity in stocks, currencies, futures, and also crypto as well, then you can also sign up to a free beta test group where you can be part of the beta test group to try out our new service that we have. Okay, so definitely have a little play with that. Go on and give it a go. See what you think. That is it. Remember, if you've subscribed to the mailing list today, remember what to expect is you'll get the deviations for the upcoming releases for the week, unless there isn't any economic releases that I'll be covering, okay, for the week, and then you'll also get a short summary of what to expect in each session. Okay, the kind of the big bits of news to kind of be aware of for big releases in Asia, Europe, and US, and that's quite short. So just to let you know, just so I don't get your hopes up and you're thinking, oh, what the heck is this? Just to kind of make it clear, that's what it's going to be every Sunday. Okay, right. Well, you guys have a great weekend. Take care, and I will speak to you guys next time. Goodbye.